Hi there, I'm back. Okay, here comes the third lecture on Chapter 6. The preceding lecture, I showed you the constant dividend stock valuation model. It's the same as what we would use to endow a college chair. So, using the formula P sub 0, which is usually what we're going to be solving for, the price at which something trades today. Okay, in the case of a perpetuity to endow a college chair, how much of a gift do I have to make to allow that gift to throw off a certain fixed amount of money every single year to be given to the professor who occupies that chair? Okay, there is a $75,000 throw off. That's how much will be thrown off every single year. If my locked in rate of return is 4%, 0.04, I would have to give $1,875,000 to accomplish that, as you can see here. All right, that $1,875,000 sits there and goes on forever. And every year it earns 75 grand, and it's paid to the professor in and out, in and out. Okay, so if we apply that same thinking to preferred stock, you're going to get $8 for owning one share of preferred stock. So if your required rate of return of the market, your perception of that, and that's very key to us here, and I've got to give you that number, obviously, in all of our assumptions here, is 6.5%, then divide using the formula up here, P sub 0 equals D sub 0 divided by R sub S. Then $8 divided by 0.065 means that stock should be trading today at 123.08 per share. Okay, will the stock fluctuate? Of course it will, because our perception of the required rate of return of the market changes. So if that moves up to 7%, then the price of the stock would drop. It makes sense that $8 is not enough to compel us to take on that risk, so the price of the stock drops to reflect its loss of palatability, for lack of a better word. Okay? So that's how the price of a constant dividend stock is determined. All right, again, constant dividend. The dividend is not expected to change. With preferred stock, it's locked in. When you own common stock, you hope that that number is going to change. We expect constant dividend growth. Now I'm going to show you something called the Gordon model, also known as the Myron-Gordon model, also known as the constant dividend growth model, okay? And this is at the epicenter of so many common stock pricing exercises. So this is one you need to have tattooed on the inside of your eyelids. You need to know this before you wrap up my course, obviously, but also before you continue your courses of study in investment science. Okay, so when you have a mature public company that is paying a dividend, you not only want to receive that dividend, you expect that dividend, but you also hope that it's going to grow, and usually these grow at a very modest percentage, but it is growth nevertheless. Okay, that is Dr. Gordon down there in the lower right, the fellow in red up here. Okay, Myron Gordon developed this very simple formula. That's simple, guys. There are three terms there that you solve for to find the fourth, okay? And yet, we're solving something that goes on to infinity. Now, how could something so simple win this gentleman such accolades in mathematical and financial circles? It's because of something he intuitively did with operations that go on to infinity. More on that later. Okay, now here's the deal. The way you read this in plain English is we're trying to find P sub 0, how much I should buy a share of stock for today. Okay, I want to know that. So I need to know three things. I need to know the dividend 1 year from now. That's very important. That's not D sub 0, that's D sub 1. Okay, I need to know what the dividend is expected to be 1 year from now. Secondly, I need to know R sub S. You need to know that for basically everything we do, because everything comes down to how we discount to today. Thirdly, I need to know G. You'll remember from a few slides back that G is, I can't find it now. All right, forget about it. But I need to know that G is my growth rate that I expect. I need to know what that number is. I need an estimate of that. Okay, now that means I've got a good idea about D sub 1. I know what my dividend was just now. I just got one. I need to know what I expect it to be a year from now. That's not hard. I need to know R sub S, and I need to know G. So I'm really basing my guesses about the price of stock on those two elements of the model. expected rate of return, required rate of return, R sub S, and G, the growth rate in my dividend. Okay, now here's one little key you've got to remember, ladies and gentlemen. Dr. Gordon's model will not work if R sub S is equal to or less than G. That's the only constraint on this model. Now, what if that's not the case? Well, there are other means you have to use, but those are for more advanced courses of study. But if R sub S is greater than G, you can use the Gordon model. All right, what if R sub S and G were the same? R sub S minus G would be 0. You know that you can't divide by 0. That's mathematically not defined. Okay? Secondly, what if R sub S were less than G? Well, then you would have a negative number in the denominator leading to a negative price of stock. That would be like a negative price of stock means that you would have to pay me to buy it from you. Okay, so that makes no sense. So as long as R sub S is greater than G, as long as that condition is met, without fail, you use the Gordon model. Now please remember, the last line there, use D sub 1. Never, 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 never try to use D sub 0. Okay? Very important. All right? Having said that, that's a very easy formula. I'll explain how it deals with infinity later. All right, here's a fictitious company called Warren. They issued a $1.50 dividend per share on its common stock. Investors believe, and I put an exclamation point there because everything is based on this belief, right? Okay, investors in the market believe that Warren will be increasing its dividend by 4.5%. The R sub S, we've got to have that number, is 11%. We have to solve this in 2 steps. Okay, first, we have to take D sub 0, which we know, it's $1.50. We have to grow it by 1 more year at some rate. What's that rate? It's G, the rate of growth. We think that the stock's dividend will grow by 4.5% per year. We need to know D sub 1. So we take D sub 0, $1.50 per share, and we multiply it by 1.045. That's 1 plus 4.5%. A lot of people say, why do you do that? Shouldn't you multiply it by 4.5% and then add it? Yeah, but that's 2 steps. Why do something in 2 steps as a business person that you can do in 1? Right? So we're going to take 1 plus the interest rate, 1.045, times $1.50, and that's going to reflect 1 year of growth at rate G. 1 year from now, therefore, the dividend, D sub 1, should be $1.57. It's $1.50 now, but a year from now it'll be $1.57. You've got to grow that numerator by 1 more year. Okay. Also, step 2, now that you know what D sub 1 is, you plug it into the Gordon formula. P sub 0, therefore, is going to be equal to D sub 1, $1.57, divided by R sub S minus G, that's 11% minus 4.5%. That's 6.5% or 0.065. Math it out, and that means that today that stock should be trading, there's the miracle, ladies and gentlemen, at $24.15. That's how you use the Gordon model. This is also going to be at the hub of the 3rd model I'll show you, and it's at the hub of many others, okay? So please, master the Gordon model, and don't ever use D sub 0 in the numerator, or I'll lose my lunch, okay? Okay, try this one. You have a company called Tucci, named after the CEO of EMC Corporation. They just issued a dividend of 50 cents per common share. Rate of return in the market is 10%, and G is believed to be 7. These are high numbers, but I'm just having a little fun here. This is all about the math. How much should you pay for a share of Tucci today? Well, plug it in. We're going to grow the numerator by 7% to get D sub 1. So take 50 cents times 1.07. You're going to divide it by R sub S minus G. That's 10% minus 7%, or 0.03. And you'll find that you should pay $17.83 for a share of Tucci today. If you can buy it for less, grab it. If you have to pay more than that, don't do it without a darn good reason. Okay? Okay, why do stock prices fluctuate constantly, within minutes, and always are on the move? It's because our perceptions of R sub S and G are dynamic. They're always changing. The numerator won't, but the denominator will. Okay? Our perception of R sub S is based on risk. We will learn that in Chapter 8. That perception can change throughout the day. One little negative piece of news by Matt Lauer on the Today Show in the morning can set the markets back on their heels. Okay? Down, up, whatever. So as our perception of risk and R sub S, the rate that requires us to enter a market, given that risk, as that changes, so does the stock price. So yes, it can be reduced to a mathematical model, but variables within that model are subject to rapid change. Therefore, so is the price of stock, and that is why the markets fluctuate, friends. Okay. The third model I'm going to give you is two-stage dividend growth, and this happens when a company is really in a highly advanced revolutionary technology, nanotechnology, a new biomed breakthrough, a cure for cancer, things like that. Now, there can be an incredible surge in dividend potential and growth, especially as the company tries to really nail some investors and say, look at this, we did it. We have something revolutionary here. We're going to incentivize you with incredibly growing dividends. We call that supernormal growth. Now, that's not sustainable. You can do it for a few years, but you can't do it for long because, again, the cruel irony is that the company needs that money inside to fund its growth. So it's going to reward its early stage investors with a high rate of dividend growth, but then after a short period of time, those, as I said in my last lecture, those dividends and their growth must level out to something more reasonable. It is not sustainable. Okay? So the early stage we're going to call the supernormal growth phase, followed by a normal growth phase. That's why we call it two-stage growth. Okay? We are going to use the Gordon model, but we can't use it right away because we're working in two stages. So we're going to attack it in two stages. First, we're going to analyze the supernormal phase. Then, once we get beyond that supernormal phase, we analyze when things smooth out. In that case, it turns into simple discounting and the Gordon model. Okay, remember, always dealing with discounting. Right. There are 5 things you will need to know to solve one of these things, ladies and gentlemen. You need to know the length of the supernormal period. How many years can we expect this high rate of dividend growth to continue? I've got to give you that. I've got to give you all 5 of these. Number 2, during the supernormal period, what will that supernormal dividend growth rate be as a percent? Number 3, what is D sub 0, the dividend paid at the starting point? You always have to have that. That's the start, the launch point of everything we do in this math slinging that we're up to. Number 4, once we get by the supernormal growth phase, we need to know what dividend growth rate is expected thereafter when things normalize. And finally, we need to know always the required rate of return. That thing haunts us like a bad penny. It's always going to be there. R sub S must always be provided. All right, when you know all 5 of those things, ladies and gentlemen, now you can reduce any two-stage supernormal growth problem to 3 easy steps. Now, please note something, right? In Model 1, Model 2, and now this Model 3, these are all very procedural. Follow the steps, okay? If it works here, if it works in the homework, it's going to work on a quiz. No one can change those rules. Here are the 3 steps in a two-stage supernormal dividend growth situation. Step 1, we're going to calculate the dividend growth during the supernormal phase. Dividends will be growing. Step 2, now we're beyond that supernormal phase. We enter the normal growth phase. That means you can use the Gordon model. Constant dividend growth, right? And you'll calculate projected stock prices once the normal growth phase begins and you're out of the supernormal growth phase. Finally, step 3, you take step 1 and step 2 and you discount all of those future cash flows. Does this sound familiar? This is like deja vu. Take all of those expected future cash flows, discount them to today, thereby taking the effective time out of the equation, and that's going to tell you the present value of those future cash flows, that's how much you should pay for a share of that stock today. So we've got a company we'll call Gaston Technologies. They have a very profitable and lucrative launch in revolutionary technology, and they are able to break loose an incredible amount of cash to reward their early stage investors. Quite common. Okay, common here in the Cambridge, Boston area anyway. Now they just paid a 75-cent dividend. There's one of our factors. We know D sub 0. They expect 3 years of 17% growth. Okay, now we know the length of the supernormal period, 3 years. We know during that supernormal period that they're going to grow at 17%. They can't sustain that. You can't pay out a 17% dividend and survive. It's got to come back to the world of sanity at some point. All right, after that, dividend growth will normalize at 8%. That's incredibly high, but this is just an illustration, okay? And finally, the required rate of return is 11% for a company of this risk profile. That's the rate you will use to discount. 1, 2, 3, 4, 5. I've given you the 5 pieces of information that you require to solve this problem. Okay, step 1. You need to grow the dividend every single year for the supernormal growth period. That's 3 years. Okay? Now we know D sub 0, you just paid 75 cents. So we go out 3 more years at 17%. So I'm going to take this math to 3 decimal places, ladies and gentlemen. That's what I recommend you use throughout our course. All right, 75 cents. Multiply that by 17%. That's $0.128. Add it to the 0.750, and you get a dividend 1 year from now of just over 87 cents, just shy of 88 cents, 0.878. Do it again. Grow by 17% again. The 0.878 becomes $1 and just about $1.03. Grow it 1 more year at 17%. We can't keep that growth up any longer. That means our D sub 3 is going to be just about $1.20, $1.201. Okay? Keep those cash flows in mind. We're going to need to use them all. All right? Take that, put it aside. Okay? All right. Step 2. Now you're 3 years in the future. So take yourself from here and, like Michael J. Fox, put yourself out here in the future. Okay, now you're sitting here at the 3rd year. Now you know what the dividend is that you just got. It's $2.01, right? 1.201. Now, pretending you're 3 years in the future, now your growth is going to normalize to infinity. Whoa, that means you can use the Gordon formula. Okay? So here we take Gordon from the preceding model, and we say, okay, first we have to grow that dividend 1 more year, but make sure you don't use 17%. Now it normalizes to 8%. So standing here 3 years in the future, 1 year from then, year 4 if you want to call it that, means that we expect the dividend to be $1.30 roughly, $1.297. Now you can use the plug-and-play approach of the Gordon formula. Take that new numerator, 1.297. I'm standing here 3 years in the future, 1 year from now, that's going to be 1.297. All right, I take my required rate of return, 11%, minus my normal growth rate, G, of 8%, math it out, and P sub 3, the price of this stock 3 years in the future, is $43 and just over 23 cents. Okay, now, back to the past. Michael J. Fox, okay? 3 years from now, that's how much the stock is worth using Gordon. But that's still 3 years in the future. I've got to reel that sucker back in to today, back at P sub 0. So step 2 of this model is done. I now have step 1's cash flow and step 2 cash flow. Step 3 means I have to discount them all. I now know all my future values, each year of dividends in the next 3 years of supernormal growth, and the price 3 years from now once normal growth begins. Read this carefully, friends. All right, now I bring them all to today's value. These are not annuities. This is not an annuity. The numbers are all different. So I'm going to have to do all separate calculations. Go to Exhibit 6.1 in the text for an illustration. Okay? You'll see a timeline there. Here's how you math it out. So I'm going to take every one of my calculated values in Step 1 and Step 2. Okay? My Year 1 dividend, my Year 2 dividend, my Year 3 dividend, and don't forget the stock value from Step 2, the Gordon value of 43.233. I go to my present value table, Table B, the 11% column, and I look up 1 year, 2 years, 3 years. And I multiply the first number by the second number to get the present value. 79 cents for Year 1, 83 cents for Year 2, 88 cents for Year 3. Now I also have to take that Gordon value 3 years from now, $43.23, and reel that back to today as well. I use 3 years, I'll get my fingers to do that right, 3 years, the 11% column, and that means today's value is $31.60. We add all those present values up, all four of them, and we get $34.11. Based on the present value of future cash flows, that is how much you should pay for 1 share of that stock today. Okay? All of this is noted for you in the book. Let's go take a quick peek at it. Okay, study this for me very carefully, friends. There it all is. It's on the slides, it's also here, and I've thrown it in on a timeline as well, plus or minus a penny or two. Okay? All right, very good. And I'm going to stop there. I want you to study these 3 models. You will see these again in the future, ladies and gentlemen, when I come back to do my last lecture. I think it'll be my last lecture on Chapter 6. I'll explain how infinity calculations are possible. Okay. Thank you for your kind attention. We're making excellent progress on this chapter, and I'll be back with one more lecture.